You've done it. You finally jumped into crypto. You put $1,000 into Bitcoin. You watched it climb. And then feeling like a trading pro, you spotted an opportunity. A hot new altcoin is absolutely mooning, and you just know this is your shot. So you do what feels like the most logical thing in the world. You swap that Bitcoin for the new coin and watch your portfolio with a huge grin on your face. You think you've just made a brilliant financial move. You feel smart. You feel like you're ahead of the game. But what if I told you that simple 2-click swap, a trade that took less than a minute, was a catastrophic mistake? What if I told you that single move, which you thought was just moving chips around the digital casino, could legally force you to pay more in taxes than your entire initial investment was worth? That's not a scare tactic. It's a documented reality for countless new investors who make this one simple, devastating error. In this video, I'm going to break down the single most common and costly crypto tax mistake that absolutely wipes out beginners. It's a silent portfolio killer that most people never see coming until it's way too late. And more importantly, I'm going to show you exactly how to understand it, how to get ready for it, and how to make sure this mistake doesn't cost you everything. Let's be crystal clear about something right from the start, and I'm talking specifically about how things work in the United States here. The government, and the IRS in particular, does not see your crypto-to-crypto trade as a simple swap. In their eyes, you didn't just trade your Bitcoin for some hot new altcoin. According to their official guidance, you actually did two separate things. You sold your Bitcoin for its cash value at that exact moment, and then you used that cash to buy the new coin. And that first part, the selling of your Bitcoin, is what's called a taxable event. Every single time you trade one cryptocurrency for another, you are generally triggering a potential tax liability. It doesn't matter if you never cashed out to your bank account. It doesn't matter if the money never saw the light of day as fiat currency. The moment you clicked confirm on that swap, you created a taxable event. This is the fundamental concept that when people don't get it, leads to financial ruin. To really get the gravity of this, let me tell you a story. It's a story I've seen play out with different names and different coins, but the painful ending is always the same. Let's call our investor Alex. Alex is new to crypto, but they're smart and eager. In early 2024, Alex invests $5,000 into Ethereum when the price is, let's say, $2,500 per coin. So Alex now owns 2 ETH. For the next few months, Alex just holds. The market is buzzing, prices are climbing, and Alex is feeling great. By the end of the year, a massive bull run takes hold. Ethereum skyrockets to an incredible $10,000 per coin. Alex's initial $5,000 is now worth a staggering $20,000. Alex feels like a genius. Now Alex starts diving deep into crypto Twitter and Telegram groups and hears whispers about a brand new revolutionary altcoin. We'll call it Future Coin. It's being hailed as the next big thing, and its value is pumping daily. Alex gets that feeling, that FOMO, the fear of missing out, and decides to go all in. Alex doesn't want to put more cash in, so the choice seems obvious. Use the massive Ethereum gains. In a single transaction on a popular exchange, Alex swaps the 2 ETH, now worth $20,000, directly for a massive bag of Future Coin. The transaction is seamless. Alex's portfolio still shows a value of $20,000 just in a different coin. To Alex, it feels like nothing really happened. It was just a transfer, like moving money from a savings account to a checking account. No big deal. Alex holds Future Coin, dreaming of its potential, but the crypto markets are notoriously volatile. The hype around Future Coin dies, a massive market correction hits, and the value of Future Coin plummets. By the time tax season rolls around in April 2025, Alex's portfolio, once worth $20,000, is now worth only $3,000. It's a painful loss, but Alex thinks, well, that's crypto. At least I don't owe anything, since I never cashed out and actually lost money, and this is where the nightmare begins. Alex gets a notice from a crypto tax program, or even worse, from the IRS. It says there's a huge tax liability. Alex is completely confused. How is that possible? Here's the brutal math Alex didn't understand. When Alex swapped that $20,000 worth of Ethereum for Future Coin, The IRS saw it as Alex selling the Ethereum. Let's break it down. The original investment, the cost basis in Ethereum was $5,000. The value of that Ethereum when it was swapped was $20,000. The capital gain is the sale price minus the cost basis. So $20,000 minus $5,000 equals a $15,000 capital gain. Now, let's say Alex held the Ethereum for just under 12 months, making this a short-term capital gain. This is a critical detail because short-term gains from assets held 1 year or less are taxed at your ordinary income tax rate, which is much higher than long-term rates. Let's just use a modest 24% federal tax bracket for this example, but your actual rate depends on your total income and filing status. So the tax owed is 24% of that $15,000 gain. That comes out to $3,600. And that's not even counting state taxes, which could easily add another several hundred or even $1,000 to the bill. Now, stop and really think about this. Alex is staring at a tax bill for around $4,000, but the entire value of Alex's crypto portfolio is now only $3,000. Alex legally owes the government more money in taxes than the entire investment is currently worth. The profit that created this tax bill has completely vanished, but the tax liability doesn't care. It's a debt to the government based on the value at the moment of that one single trade. Alex is now in a horrifying spot. Sell the remaining crypto for $3,000, hand it all to the IRS, and still have to come up with another $1,000 to settle the bill. The initial $5,000 investment is gone. The paper gains are gone, and now Alex is in debt. This one mistake, born from a simple lack of knowledge, has not only wiped out the entire investment, but put Alex in a worse financial position than before even starting. This isn't a scare tactic. It's the direct consequence of misunderstanding a fundamental rule of crypto taxation in the US. So how can a situation this disastrous even happen? It all comes down to one core concept you absolutely have to burn into your brain. For US federal tax purposes, the IRS views cryptocurrency not as currency, but as property. This is the golden rule, the central pillar of all U.S. crypto tax law since IRS Notice 2014-21. Think of your crypto not like the dollars in your wallet, but like a stock, a piece of real estate, or a collectible. Even if a country like El Salvador makes Bitcoin legal tender, the IRS still considers it property for U.S. tax purposes. When you trade a stock, say, selling Apple to buy Google, you know that's a taxable event. If you sell a house to buy another, you know there are tax implications. The exact same logic applies here. Because crypto is property, anytime you dispose of it, you generally trigger a taxable event. And dispose is a key word. It doesn't just mean selling for cash, it includes it. Selling crypto for fiat currency, like US dollars, this is the obvious one. Trading one cryptocurrency for another, this is the mistake Alex made. Swapping ETH for future coin is disposing of ETH, using crypto to buy goods or services. That pizza or laptop you bought with crypto, you effectively sold the crypto at that moment's value, creating a taxable event, earning crypto as income. This includes getting paid for a job, mining rewards, or most staking rewards, which are taxed as ordinary income when you receive them. Let me hammer this home. Every one of these actions requires you to figure out if you made a gain or a loss on the crypto you just got rid of. Thinking you can live entirely in the crypto ecosystem, trading coins back and forth without ever cashing out, and have no tax obligations is a fantasy. And it's a fantasy that leads to devastating real-world consequences, as we saw with Alex. The most insidious part of this is how counterintuitive it all feels. Exchange user interfaces make swapping coins feel so fluid and simple. There's a button that says swap or convert. It doesn't have a giant warning label that says you are about to sell your current asset, realize a capital gain, and then buy a new one. The ease of the transaction completely masks the complex tax reality happening in the background. This is why your fear shouldn't just be about the market crashing, it should also be about the tax man. The IRS has been significantly increasing its focus on crypto tax compliance. adding that digital asset question to the front of Form 1040 and getting more data from exchanges. The idea that your transactions are totally anonymous or untraceable is dangerously outdated. Understanding this single principle, that crypto is property and every swap is generally a sale, is the most critical step to protecting yourself. It changes how you look at every single trade you make. All right, we've laid out the problem and the painful consequences. So how do you avoid becoming another Alex? The answer isn't to stop trading. It's to become a smart, informed investor who understands the rules of the game. And that starts with knowledge and discipline. First, you need to get comfortable with two simple terms: cost basis and capital gains. Cost basis is just what it cost you to get an asset, including fees. In Alex's case, the cost basis of the 2ETH was the initial $5,000 investment. If there was a $50 fee on that buy, the cost basis would actually be $5,050. It's your total all-in price. Capital gain or loss is the difference between your proceeds from the sale and your cost basis. When Alex swapped the ETH for future coin, the ETH was worth $20,000. So the proceeds were $20,000. The capital gain was the proceeds, $20,000, minus the cost basis, $5,050, which equals that painful $14,950 gain. If Alex had swapped when the ETH was only worth $4,000, it would have been a $1,050 capital loss, $4,000 proceeds, $5,050 cost basis. Capital losses are actually valuable. They can be used to offset your capital gains and even up to $3,000 of your ordinary income per year, which is a strategy known as tax loss harvesting. This is why tracking everything is so crucial. So the first part of the solution is this. From now on, you have to treat every single transaction as a record-keeping event. You need to be your own financial bookkeeper. For every single transaction, buy, sell, swap, or spend, you must record the date of the transaction, the asset you acquired, and the asset you disposed of, the quantity of each asset, the fair market value in your local currency, e.g. USD, at that moment. This is your sale price, your cost basis for the asset you got rid of, any transaction fees, because they can be added to your cost basis, which reduces your gain. Let's replay Alex's trade, but this time Alex is an informed investor. January 15th, 2024, buy. Action. Buy 2 ETH. Cost basis, $5,000 plus $50 fee equals $5,050. Record. Bought 2 ETH for $5,050 on January 15th, 2024. December 10th, 2024. Swap. Action. Swap 2 ETH for 10,000 future coin. Fair market value of ETH at swap, $20,000. These are the proceeds. Cost basis of the ETH, $5,050. Capital gain, $20,000 minus $5,050 equals $14,950. Record, sold 2 ETH for $20,000 value. Realized short-term capital gain of $14,950. Now, because Smart Alex recorded this, there's no shock in April. Alex knows a $14,950 short-term gain was realized. Knowing this changes everything. Alex might decide to sell a bit of future coin right away to set aside cash for the tax bill, or Alex could look for losing investments to sell before year end to offset that gain. The key is awareness. The simple act of recording the transaction forces you to see the tax hit in real time, not months later when it's a crisis. You move from being a reactive victim to a proactive investor. Does this sound like a ton of work? Yes, it absolutely can be. A year of active trading can generate thousands of taxable events. Manually tracking this in a spreadsheet is a recipe for a nightmare, which brings us to the second part of the solution. And hey, if you're finding this breakdown valuable and it's opening your eyes to how these tax rules work, do me a favor and hit that subscribe button. My goal here is to give you the clear, straightforward info you need to navigate crypto safely and profitably. Subscribing makes sure you won't miss future videos that could save you from another costly mistake. Trying to manage your crypto taxes by hand is like trying to build a house with just a screwdriver. You might get somewhere, but it's going to be brutal, slow, and probably fall apart. In today's crypto world, you need a proper toolkit. Your number one tool is crypto tax software. Platforms like CoinLedger, Coinly, CoinTracker, and ZenLedger are designed specifically to solve this headache. For anyone who is even moderately active in crypto, these tools are absolutely essential. Here's how they work. You connect your exchange accounts and public wallet addresses, and the software automatically imports all of your transactions. It crunches the numbers on your entire history, every buy, sell, and swap, and does the heavy lifting for you. The software will calculate the cost basis for all your assets using IRS-accepted accounting methods like FIFO, first in, last out, first out, or specific identification. Find the fair market value are in USD for every single trade. Identify every taxable event and calculate your capital gain or loss. Generate the necessary tax forms, like Form 8949, which you or your accountant can use to file your taxes. Using one of these tools turns your tax process from an impossible nightmare into a manageable task. They can synthesize thousands of transactions into one report and give you a clear picture of your tax liability all year long, so you're never flying blind. Now, a crucial second part of your toolkit should be a human, a qualified tax professional. While tax software is powerful, it's not perfect. Complex activities like DeFi lending or certain NFT trades might need a human review. If you have a lot of activity, the guidance of a CPA or tax lawyer who specializes in crypto is invaluable. Think of it as an investment in peace of mind. And the rules are getting even stricter. Starting with the 2025 tax year, which you'll file in 2026, brokers will be required to report digital asset transactions directly to the IRS on a new Form 1099-DA. This means the IRS will have even more data to check against what you report. The era of hoping they don't notice is rapidly coming to an end. Getting your reporting right is no longer optional. And hey, if you're finding this breakdown valuable and it's opening your eyes to how these tax rules work, do me a favor and hit that subscribe button. My goal here is to give you the clear, straightforward info you need to navigate crypto safely and profitably. Subscribing makes sure you won't miss future videos that could save you from another costly mistake. So let's zoom out and look at that one devastating mistake, swapping one coin for another without understanding the tax hit. It's an error born from the slick design of modern exchanges and a basic misunderstanding of the law. It can turn the thrill of a bull market into the terror of an impossible tax bill. But now you know better. You know that for U.S. tax purposes, the IRS treats crypto as property, and that a crypto-to-crypto swap is generally treated as a taxable sale. You understand the nightmare scenario of how a paper gain can create a very real cash debt that can wipe you out, and you've seen the math that proves it. And most importantly, you have the solution. It's a two-part defense. First, the discipline of meticulous record keeping, tracking your cost basis and capital gains in real time. Second, leveraging the power of crypto tax software to automate the process and the wisdom of a tax professional to guide you. Don't be intimidated by this, be informed. The goal isn't to scare you away from crypto, it's to arm you to navigate it intelligently. By understanding and respecting the tax implications of your trades, you protect your capital, you secure your gains, and you make sure your crypto journey is a story of success, not a cautionary tale like Alex's. Track everything, trade smart, and you will stay ahead of the mistake that costs beginners everything.